All right. Hello, everybody. For those of you on the East Coast, good afternoon. For those of you out west, happy late morning. We're going to go ahead and get started now. Before we jump in, a couple of things that I want to highlight to everybody. Number one, this webinar is being recorded. We will have it posted to the LARC's website, larcanalytics.com, within the next 24 hours. Number two is the slide deck will be emailed out to everybody that it attends. So if you attended, you logged in, you will get the slide deck. You don't need to ask for it. Point number three, there will be a Q&A at the end of the presentation. Katie Harding, who's on here with me, and one of my teammates at LARC is going to go ahead and moderate that Q&A. There is in your taskbar an option to ask questions. Just go ahead and lob any questions in there. We will go through them at the end. If for some reason you are uncomfortable asking a question in webinar format or something comes up to you later after the fact, feel free to email me at information@larcanalytics, LARC analytics.com, and I will answer. And the last thing that I'll highlight is we will be at the Hunter Hotel Investment Conference in a couple of weeks down in Atlanta. If anybody wants to catch up with us, meet face-to-face, learn a little bit more about some of our offerings, feel free to reach out. Again, information@larcanalytics.com, and we'll be happy to get you squeezed into our schedule. With that being said, we're going to jump start right now. For those of you that don't know me, my name is Ryan Melliker. I am the president and co-founder of Lodging Analytics Research and Consulting, or LARC for short. And we're going to get started here. There's a lot to cover today. This is our agenda. We're going to go through it pretty quickly as we possibly can over the course of the next hour. We'll try to save a few minutes for Q&A. As I mentioned, the slides will be sent out to you and the recording will be sent out to you, or will be posted on our website, I should say. So don't fear if you miss anything or I go too fast over something. There will be an opportunity to revisit the slides on your own time, as well as review what I might have said about a particular slide. That being said, when we think about where the U.S. industry is today, this recovery is basically transitioning into expansion and out of recovery. The chart on the right here shows you monthly change in occupancy, ADR, and RevPAR relative to 2019 levels, not only year-over-year basis, but relative to pre-pandemic. And what you can see basically is that, ADR and RevPAR, which are these top two lines, have been well above 2019 levels for a while, but we aren't seeing a tremendous amount of growth over the past few months from where we've been. Occupancy has continued to tick up, but still hasn't quite reached 2019 levels. In fact, by December 2022, U.S. trajectory remained promising. ADRs were 16% above 2019 levels, RevPAR 15% above them. But a month later in January, that growth rate relative to 2019 dropped a little bit. ADR was 15% above, 1 point down. RevPAR 11%, 4 points down. And then on a rolling 3-month basis, one of the things that's kind of interesting is that occupancy levels have plateaued at around 2% below 2019 levels, while ADR and RevPAR growth have dropped slightly on a growth level. Still positive growth, just the growth rate relative to 2019 is moderated a little bit. Some of that is seasonality driven, and some of that is related to a softening economy, which we'll walk through in a little bit. But bottom line is fundamentals remain particularly strong and improving. Moving on, while that's the case nationally, locally, you don't necessarily have that same impact. At LARC, we do forecast work on 50 markets. And if you look at those 50 markets that you see right here, and you look at 2022 RevPAR versus 2019, across the US, RevPAR was 8% above 2019 levels. 34 of our 49 cities were positive in 2022 versus 2019, up from 8 in 2021. But the market divergence is extreme. Left-hand side of the chart shows you Palm Beach, Mobile, Tampa, Puerto Rico, all really, really strong. Right-hand side in 2022, San Francisco, San Jose, Portland, etc., really, really weak. There's a huge disparity between up 30 and down 30 at the extreme ends relative to 2019 levels. Important to keep in mind, what's driving the individual markets really matters, and there will continue to be markets that are winners and markets that are losers. And for anybody that's on this call that is interested in understanding that, we can certainly help. But regardless whether you use us or not, you have to understand that what drives a market is going to be different over the next 5 years than it was over the past 5 years. And trying to use the simple math that you've used in the past doesn't necessarily work. So whether you're an investor, an owner, a lender, an operator, a developer, these are things that are really, really, really important in terms of going forward. Moving from RevPAR to ADR, see a similar story here, right? Again, here the US was a little stronger. ADR was up almost 14% relative to 2019 levels in 2022. Again, 34 markets were positive relative to 2019, and divergence remains very disparate, right? You've got several markets up over 25%, Palm Beach up over 35% in terms of ADR, and then still several down over 10%. So there is this continuing disparity between the haves and the have-nots in the markets. And we're going to talk a little bit about how that's going to change. There's always going to be a disparity, but which markets are the haves and which markets are the have-nots a little later on. When you think about TSA throughput and air traffic, we've historically shown this data on a 7-day or 14-day moving average. Here we're showing it on a 30-day moving average because I think it paints a pretty clear picture of a relatively positive trend. Things kind of plateaued through much of 2022, but then in the fourth quarter, we saw a big spike up and we haven't pulled back from that spike up, which is really, really encouraging when you think about air traffic. And we think that's really tied to corporate transient continuing to recover, something that we get a little bit more excited about, but at the same time, that excitement is somewhat muted by other factors. But at the end of the day, when you think about, we're basically looking at, in right now and, start of this year, effectively traffic volumes that are roughly on par with 2019 levels on a 30-day moving average. So that's pretty encouraging. We'll see if it continues to hold. We're optimistic. Time will tell. Hotel booking volumes, similar to what we saw with air traffic, and if you look at this top chart, the bottom line or the lighter colored line is the US, the darker colored line is global. What you'll see is basically the US kind of, from April through December of 2022, bookings generally hovered between 90 and 95% of 2019 levels, aside from the occasional spike related to a holiday. But then early this year, we started to see bookings pick up a little bit, and now we're about 5% higher than where we were throughout much of 2022, and that's pretty encouraging that you're seeing that little bit of pickup in terms of bookings. And again, we think some of that may be tied to corporate transient continuing a modest acceleration, though we think a lot of this is also tied to group. And the other thing that's happening is booking windows are starting to lengthen. If you go back a couple quarters ago, this slope was far steeper, looked something more like kind of plateauing off by May, if you will. Here we've got some real bookings out 3 or 4 months, which is encouraging. Booking windows are lengthening. People are getting much more confident in being able to book longer term, which is very good, obviously, for pricing power across the hotel industry. Now, let's talk about how this cycle is different. So, this is occupancy relative to prior cycles. Following the great financial crisis, it took 81 months for trailing 12-month occupancy to get back to prior peak. Following 9/11, it was 65 months. It has now been 44 months. Now, obviously, we fell much, much deeper during this downturn and have recovered much, much more quickly. But here we are starting to level off a little bit, though still trending in the right direction. And we're right kind of in line with where we've been in past cycles at 44 months in, which is January data, with trailing 12-month occupancy about 4.5% below prior peak levels. We're optimistic that will continue to improve. And based on the recent pace of that improvement, we'll probably pass the 9/11 recovery in the not too distant future, which would give us some confidence that maybe we beat that 65-month level. But we'll see. We also may not. Our view on occupancy is a little bit more nuanced than that, but it's just an interesting trend data point to look at. Now, that's what occupancy looks like. Here's what ADR looks like. Much, much, much stronger, right? The reality is following the great financial crisis, it took 52 months to get back to prior peak on a trailing 12-month basis. Following 9/11, it took 45 months. Following the pandemic, 25 months. We did it in March of last year, month 25. And as a result, RevPAR looks awfully similar to the combination of the two, but certainly more similar to ADR than occupancy. Following 9/11, it took 52 months. Following the great financial crisis, it took 59 months. We did it this cycle following the pandemic in month 29, which was July of 2022. And as of January of 2023, which is month 35, we're over 9% above prior peak on a trailing 12-month basis. Obviously, encouraging data, points to the strength of this recovery. But as we move forward and move from recovery to expansion, it's going to be interesting to see how all of that will continue to unfold. I wouldn't be surprised if we'll see this start to level off. When you think about values, to give you some perspective on hotel values, values, it took 8 years following the great financial crisis for values to recover to prior peak. It took 2007 to 2015. But then values continued to rise for 3 more years. And by 2018, values were 18% above prior peak. So that's obviously interesting data. This cycle, values began declining prior to the pandemic in 2019. We estimate values fell about 23% in 2020, recovered a good chunk of that in 2021, a little bit more in 2022. We thought the country would recover a little more in 2022 than it ended up doing, and part of that had to do with rising interest rates in the back half of the year. And at the end of the year, we estimate that values were about 1% below 2019 levels. Now, something that I think is really important to talk about, because we have a lot of conversations with our clients about the impact of economic growth on RevPAR and how things are different right now and everything's a little bit nuanced, and you have to take a different view. And it's all true. Our clients that come back and talk to us about this are very insightful and have good thoughts. But here's what the data says, and here's why the data is confusing. When you look at RevPAR or demand and you say RevPAR was up 3%, you're referring to year-over-year growth rates, whether that is January 23 over January 22, 1Q-23 over 1Q-22, et cetera. You're looking at year-over-year growth rates. Whereas GDP metrics and most economic metrics, not all, but most economic metrics are not. They're looking at quarter over quarter, then seasonally adjusted. So when we say GDP was up 2.9% in 4Q 2022, it's not it was up 2.9% over 4Q 2021. It's 2.9% higher than 3Q 2022 on an annualized basis. So it's not the same metric. Whereas if you turn around and take the 4Q 2022 GDP and compare it to 4Q 2021, you get a very, very different metric. And that's the metric that ultimately should be compared to how we think about RevPAR and demand growth. And that's what you see here. You see this chart going back to the start of the pandemic, where the dashed line is GDP on a year-over-year basis. And then the two solid lines are demand and RevPAR on a year-over-year basis. And you can see how close these have all moved with one another. Even in the first half of 2022, when GDP was negative on a sequential basis, it was not negative on a year-over-year basis. In fact, one of the things that we think is really fascinating is if you look at the data just during the since the start of the pandemic, growth rates from 2019 through 2022, there has been a stronger relationship between GDP and RevPAR and GDP and demand than there was in the 20 years prior. Now, all of these metrics are very strong. Do not get me wrong. But it just points that actually the economy has really been driving things at a national level. And that's good to hear. And it's also good to be aware of as we move into a period where maybe economic growth is really going to be slowing and some of the concerns that the industry has surrounding that. But while this is interesting on a national level, that relationship pretty much is totally broken down at the market level. Here you're looking at 2022 MSA GMP growth or economic growth relative to 2019 and comparing that to RevPAR over the same period. The dark blue columns are RevPAR on that 3-year growth rate, and the light blue is economic growth. And what you see is that there is a total breakdown in that relationship. The correlation is 1.2% and the R squared is 0. We go back here, the correlation was 93 and an R squared of 86.5, right? That is a massive difference, right? At the end of the day, what's driving hotel demand, hotel RevPAR at the local level is more nuanced than just aggregate economic growth. And understanding the drivers is really, really, really important, because the drivers of different markets are going to be different. And understanding that New York is driven by financial services and Houston is driven by a lot of the energy employment and factors like that, and foreign exchange rates have an impact in markets, and foreign direct investment in the U.S. is a big driver in some of the West Coast banking markets. All these factors that are more that don't necessarily drive a vast majority of economic growth have a big impact on hotel performance across individual markets. And when you take a one-size-fits-all approach to market forecasting, you get this type of disparate result. Which is why we don't do that. We look at all 50 markets that we forecast for to understand what the local drivers are, to build out models that are specific to that market. Of the 50 markets that we forecast, no two have the same grouping of drivers. It's pretty amazing how that has worked out. And I think it's one of the clear differentiators for our market forecasting versus others. And I think the point is shown really explicitly right here when it comes to RevPAR. Now, if you look at historically, the relationship was clearly much stronger for the major markets, and correlation of 42%, R square of 18%, much stronger than it was over the past 3 years, but still nowhere near what we saw on a national basis. So this is something that's always been a little bit less, been more meaningful to understand the composition of economic activity at the local level than at the national level, which intuitively makes some sense. If we fast forward, if we look at demand instead of RevPAR, you get the same type of results. Numbers are a little bit higher, 33.4% correlation, 11% R squared, still way below where we were prior to the pandemic. And again, nowhere near where we are at a national basis. So this gets back to our point that you have to really understand what's driving the individual markets, which is what we try to help our clients do. So let's move on to our economic outlook. Now, keep in mind, the economic outlook that we just highlighted illustrates that, you've got, economic outlook has a big impact on the national RevPAR metrics that we care about. But at the local level, you have to really understand what's driving the economic outlook locally, because it's not necessarily going to be that key macro factor like gross metropolitan product growth or jobs or unemployment that really drives that market. It could be something very, very different, or there could be multiple factors that are more nuanced that combine to drive things. So when we talk about the economic outlook, we're really focused on the national level here, but locally things will be different. So when we look at the national level, we're going to start with our view on office utilization, which is something that's continues to be a challenge for the hotel industry. Office utilization rates continue to remain around 50% of 2019 levels. Growth's been really limited over the past few months. We are of the view that we will not see office utilization approach 2019 levels over the next few years, if ever. Certainly not through our forecast period. That's going to put a damper on corporate transient travel, because at the end of the day, if you don't have people in the office, you have less corporate transient travel to visit those people in the office. Just something to keep in mind, as we move forward and you think about other factors. Corporate profits. Here's something that's kind of interesting. So corporate profits are projected to decline 5% this year, and then remain unchanged. We're not going to see a bounce back next year. But despite that, corporate profits are still expected to be over 20% above 2019 levels this year. So you're talking, it's down, that's bad, but you're still above 2019. Stock market, same type of story. It's down 1% year to date through the end of February, after being down 19% last year. Despite that, still 17% above 2019 levels. So in an environment when we have normalized corporate transient travel and we see profits declining and the stock market down, it's likely to have an impact on corporate transient travel and cause corporate transient travel to decline. However, because we're nowhere near that normalized level, partly driven by this return to office story. We don't think you're going to see a decline in corporate transient. If anything, we're going to see growth in corporate transient. Could these factors limit that growth or have an impact to slow that growth? The answer is absolutely yes. We think they will. But corporate transient is still in a period where, because it's such a depressed level, regardless of what's happening at the national level for some of these key corporate transient metrics, we're still going to see a period of recovery. Now, unlike corporate transient, leisure is not in a period of recovery. Leisure came back really strong, obviously, following the pandemic. And if you look at one of the factors that we look at as a leading indicator for leisure demand, it's U.S. personal savings rate. And you can see personal savings rate spiked in late 2020, and that was tied to fiscal stimulus, got to 2 times the rate of 4Q-19. It then pulled back pretty materially, spiked again for more stimulus. And now we're back down to where we were, to below where we were. That, frankly, it's lowest level we've seen since 2010. And this is an indicator that, to us, that you're not going to see that strong leisure transient demand as we head into the summer leisure season. It's going to be far more muted than we've seen in the past. Not saying the demand won't be there, but we're not going to see the growth, pricing power, those types of factors that really drove the recovery over the past couple of years. We think are facing a lot of headwinds as we move through this year. So just keep that in mind. On the flip side, there is group demand, which is incredibly strong. We track convention center bookings for 30 of the largest convention centers around the US. And right now, 2023 pacing is actually 14% above 2022 levels. So we've got bookings 14% higher than they were in 2022. Still below 2019 levels, but it's a really good year-over-year metric. Obviously, rising convention center demand and pacing gives us confidence in pricing power, shrinks the size of our hotels, helps us be more aggressive when it comes to ADR moving forward. They're all very positive things. The convention center booking data is very strong for 2023. It's going to be much softer in 2024, where we've got it pulling back about 8%. Net, we think these metrics are really positive for the industry, especially in 2023. But there are puts and takes for all of these things, right? And then I touched on fiscal stimulus before. I'll just highlight it again. The fiscal stimulus that was issued coming out of the pandemic was unprecedented, and as we've always said, it was needed, or quasi needed, to really support the economy during the pandemic. But what we had to do, what that was it was borrowing from the future to support the present. Well, now we're fast forward 2 years later, we are in the future. And that's what we borrowed from. And that's going to have an impact on our economic growth and other factors. We believe it's one of the primary, not the only, but one of the primary factors that has driven to elevated inflation and caused the Fed to be more aggressive in raising rates and fighting things, which of course has an impact on economic activity as well. So fiscal stimulus, just something to highlight. It's certainly a concern. When we think about our aggregate US outlook, first of all, let's talk about GDP growth, right? GDP was negative in the first half of the year, as we talked about. Then it accelerated to 2.6% growth. Remember, sequential annualized in 3Q 2022, and then 2.9% in the fourth quarter. For 2023, Moody's, the economist we use, expects GDP to grow 1.3% this year. And that 1.3% is driven by a negative GDP growth in the first quarter, followed by gradually accelerating GDP growth throughout the year. So one of the things that's a little bit different than what we've had in the past is, in the past, Moody's kind of thought that first quarter and second quarter would lead to a quasi-recession, 2 consecutive quarters of negative GDP growth, and a recession being declared. Moody's no longer believes that's the case. Just 1 quarter and a recession is not built into the baseline, nor is it as likely in 2023 any longer as it might be in 2024, and we'll talk about that in a minute. Unemployment is going to continue to gradually tick up through the middle of 2027, but stay muted. Inflation will moderate to below 4% by 2023. Interest rates, especially the Fed fund rate specifically, we're going to see one more 25 basis point rate hike before the Fed stalls their rate hikes and then begins to reduce them late 2024. To give you some perspective, Moody's expects the 10-year Treasury yield to be to peak in late this year at about 4.1%, which frankly is pretty close to where we're at right now. So we're not talking about rising rates materially higher than where they are now, which is pretty encouraging. Now, there are risks to that outlook, whether it is interest rates moving higher, inflation not continuing to pull back like we've seen generally over the past 6 months, or new COVID variants. Those aren't things that we have built into our baseline assumptions, but if they materialize, we could see a brief, mild supply/inflation-driven recession. But now the likelihood of that is being pushed more to 2024 than 2023. As we dig into some of that, so let's take a look at inflation, CPI. Moody's expects inflation to drop pretty materially this year. And by the middle of the year, we're looking at 3% inflation, end of the year, 2.5%, and 2024, 2%. Now, what's interesting is, Moody's had historically been far more conservative than some of the other economists. But if you take a look at the Wall Street Journal consensus estimate, now they're all pretty much moving in the same direction. Right, over the next 18 months, inflation is looking like it's pulling back pretty materially. Everybody's generally viewing that, which is encouraging. Hopefully that's what happens. But bottom line, what we saw back here is not what we're going to see going forward, and that's pretty encouraging. Rising interest rates. 10-year U.S. Treasury yield, I talked about it basically peaking later this year, right, not far off where it is right now. Which is encouraging, and it points to the idea that the Fed's only going to raise rates another 25 basis points this year, according to Moody's. If that's true, that's again encouraging and points signs to cost of debt hopefully stabilizing in the near term. If that's not true and the Fed remains hawkish, and they potentially remain hawkish too long, trying to not just slow economic tame inflation, but break the unemployment levels, which is something they've talked about in the past. If they do get more aggressive and stay hawkish for too long, tightening monetary policy past the point of equilibrium, they will send the economy into a recession. We think it's a real risk, but it's a risk, not our baseline assumption. And again, that risk is likely to have an impact, not in 2023 anymore, but potentially 2024. So our key assumptions that drive our hotel industry forecast: the Fed's going to raise rates 25 more basis points in early 2023, then pause increases until rate cuts begin in late 2024. Inflation will moderate to under 3% by 3Q 2023. Labor constraints will continue to lead to elevated wage growth through this year before things begin to moderate. No new variants will impact children or the vaccinated in any meaningful way. Russia-Ukraine conflict does not lead to military involvement in the U.S., the rest of Europe, or the West. And as a result, the risk of U.S. recession has moved from 2023 to 2024, but is no longer built into our base case assumptions. So let's talk about what all that means to our hotel industry outlook, right? Great. So first, we talked a lot about the demand segments and kind of some of the positives and negatives that are driving them. Well, here's kind of the outlook for those demand segments. First and foremost, I'll start with corporate transient. We talked about the challenges related to sluggish growth in or declines in corporate profits and the stock market. But the good news is we estimate that in 2022, corporate transient demand was only 80% of 2019 levels. So there was still depressed. As a result, we think it's going to continue to grow. It's just going to grow slow, right? We estimate that in 2023, corporate transient will recover another 5 to 10% of its demand levels and be at about 85 to 90% of 2019 levels. And that's around where it's going to stay for the next few years. Group, on the other hand, is going to be stronger, right? We've got group was roughly 15% below 2019 levels in 2022. And going forward, we see a strong snapback in group demand this year. We've talked about it. Group will basically be really close to 2019 levels this year. And by 2027, it'll be 10% above 2019 levels. So pretty strong, substantial strength in group. And the last point is leisure. Leisure, we estimate in 2022 was about 50% above 2019 levels. We don't think that's where it stays. We think there was a lot of pent-up leisure demand. Savings was really strong. As all of that unwinds, we think leisure demand will stay above where it was historically, but nowhere near those levels. We estimate that it's going to be around 30% of 2019 levels this year, which is around where it will be over the next few years. Bottom line here is when you've got office utilization well below historical levels, fewer people in the office leads to fewer corporate transient work trips to meet those people in the office. And those trips that do happen tend to be for fewer nights because you don't stick around the extra day for the extra meeting because there isn't an extra meeting. That's number one. But number two is if fewer people are in the office, that means you want to get your teams together more frequently. You can do that through two different ways. Either bring larger teams to conventions, so you bring the extra 1, 2, or 3 people to a particular conference or convention that you wouldn't normally do to help with the team building and camaraderie. And 2, you have your own internal meetings. All of that's positive for group. The third thing that goes on here is that when you have people not in the office 5 days a week and it's more of a hybrid environment, you have the ability, those people have the ability to work remotely 1 or 2 days a week. And that will probably help leisure demand, where those people may choose to travel for an extra long weekend or two every year. And as they do that, that's going to help stabilize that leisure demand well above where it was pre-pandemic. So net, we're very encouraged by leisure relative to pre-pandemic, very encouraged by group relative to pre-pandemic, corporate transient, not so much. But relative to 2022, corporate transient and group are going to be strong this year, while leisure is going to weaken. And it's just because it's off of such a high base. So when we move on to our supply dynamics, our outlook for supply has not changed a lot. It's rather benign. Hopefully you guys can see. I'm trying to get the bar on my screen to go away. Oops. I don't want it to be blocking the page, but for some reason it seems to not want to go away. Hopefully you guys can see the slide all right. But we're gonna hold on 1 second. I'm sorry. I don't know why this thing doesn't go away. Okay, or you guys don't see it maybe, which is great. So when we look at the supply, the one thing that I'll highlight to you is that our supply is roughly around 1.5% this year, 1.5% next year. And as we move forward, supply growth is going to stay muted. We estimate a 1.0% supply CAGR over the next 5 years, well below the roughly 2% CAGR that we had seen in the 20 years leading up to the pandemic. So this is pretty encouraging. 2025 will be even more muted, under roughly 0.5%. So all that's pretty positive. But we'll see how all that unfolds going forward. We remain pretty encouraged by supply growth. Here's our RevPAR model. When you think about our RevPAR model, the dark blue line that you see across this chart is actual STR or CoStar RevPAR data on a national level, seasonally adjusted going back to 2000. The light blue line is the model that we've built to forecast that RevPAR data. As you can see, we've forecasted that RevPAR data historically, as well as forecasted it moving forward. Our model is a 99.5% R squared, and the key model drivers are here. ADR, same thing. Dark blue line is the actuals on a seasonally adjusted basis from STR and CoStar. Light blue line is the model that we have forecasted. We've built to forecast that 98.7% R squared. Combined, these are the factors that drive that model, slightly different than RevPAR. This is our actual forecast, and this shows you kind of a little bit of how we compare to some of the other guys out there. For 2023, we've got occupancy at 63.8%, ADR 155.29, and RevPAR of 99.15. Generally speaking, there's a few of us that are in the same ballpark. Some are lower, some are in the same ballpark. Bottom line here is that we continue to be among the highest, if not the highest, when it comes to 2023 ADR. And ADR is really where we think that the industry is going to perform pretty well. Occupancy will improve, but as you will see here, We don't see occupancy really growing much beyond stabilizing in that 64% level, whereas most of these other guys that are forecasting beyond 2023 have occupancy continuing to improve. We're a little bit more cautious on that. We think it's going to come in the form of ADR thereafter. And as you look at 2023, what we can tell you is that the growth is heavily weighted to the first quarter. We estimate RevPAR is up about 16% in the first quarter. And then over the following 3 quarters, you're looking at about 4% year-over-year growth on average. Now, why should you trust our forecast versus the others? Well, there's a few reasons why you should trust our forecast versus the others. First of all, our mantra is better data in equals better data out. We use what we believe are only the best data providers. And we're not affiliated with the data providers that drive our models. So historical operating results, STR and CoStar, again, we believe they're the best. I don't want to get into details as to why that is, but we have a pretty strong view on that. Detailed economic summary, Moody's Analytics. There's another big player out there that does economic forecasting that lots of other forecasters use. They cost less than half of Moody's. There's a reason for that. We wish that they were better. If they were better, we'd be using them and saving ourselves a lot of money. But we've done the legwork on that one. Citywide pacing data. Nobody else pulls citywide data into their models. We do. We think it's kind of important for the hotel industry. So we get data from the local CVBs, as we talked about earlier. Health of the office market, that comes from a company called Reis that Moody's owns. Reis is basically an SDR for the office industry. Supply pipeline data. We are not a pipeline data provider. We leverage pipelines from others to build out our supply forecasts. Challenge that we all have had with pipeline data over the years is that oftentimes there's a lot of erroneous data. There's flaws. It's incomplete. There's duplicates, things like that. We marry multiple pipeline data sources and then do a lot of scrubbing ourselves to make sure that we've got the right forecast data from supply for each market that we track. And then short-term rental data comes from AirDNA. Historical cap rates come from Real Capital Analytics and CoStar. And then transaction commentary that goes into our reports but doesn't drive our models comes from our partners over at LW Hospitality Advisors. And fortunately for us, our mantra of better data in equals better data out has led to better data out. If you go back and look at the 2022 forecast at the start of the year, or 2022 forecast at the end of December 2021, you can see where those forecasts were at the bottom of the screen on the left here. You'll see where those forecasts were for 2022 when we went into the year. You can see where our forecast was and where everybody else's forecast was. You can then see where the actual results came out. We missed occupancy by 30 basis points. ADR, we were light, but we were higher than anybody else. And then RevPAR, again, light, higher than anybody else. Now, interestingly, one of the things that we highlighted in our December 2021 client letter was that we thought our ADR metric might be light because we didn't think our models did a great job of capturing the elevated inflation that was expected in 2023, because we had not seen that since we started getting lodging industry data being tracked in 1987. Last time we saw that type of inflation was in the 70s. So our models could not account for that type of impact. We weren't sure how it was going to play out. We didn't think that our models accurately reflected it. We highlighted that to our clients. It certainly played out. And even with that, we were still closer than everybody else on ADR and RevPAR. And if you think 2022 was an anomaly, here's 2021. December 2020 for 2021. Again, we were by far the closest. 3 times closer on occupancy, closer on ADR, and almost 2 times closer than everybody on RevPAR. So do the math, 2 years in a row, during challenging forecasting times, we've been by far the closest. I don't think this year is any different. Moving on, look at our price class forecast. This chart here shows year-over-year growth for the price classes, luxury down to economy. What you'll see in the light blue columns is that we generally expect the higher tiered segments to outperform this year. Luxury, upper upscale, and upscale will be stronger, while upper midscale, and economy will be weaker. That's driven by the strength in group, improving corporate transient, and waning and challenges related to leisure demand. If we move forward and compare to 2019 levels, we get a slightly different picture here. Again, luxury still very, very strong. But now you look at economy and mid-scale, and upper mid-scale that relative to 2019 will still be stronger than upper upscale and upscale because of the growth that they've had to date. So at the end of the day, we have pretty positive views on year-over-year growth at the higher end, but the lower end is still going to be performing better relative to 2019 levels as we move through this year. Let's move on from the top line and focus a little bit more on the bottom line. So when you think about expenses and some of the factors that drive expenses, property taxes grow at a 5.4% CAGR over the next 5 years. That data is really driven by our analysis of local municipal budgets and their outlook for where spending is going to go and how they're going to be raising those funds and their general budgets over the next 5 years related to property tax increases. Wages will increase at a 5.8% CAGR through 2027. That's data from Moody's Analytics. Wage growth is particularly high this year, not surprising, and it will continue, and then it will moderate in 2024 and stabilize around 4% thereafter. We grow other expenses at inflation. We have the historical levels of cost flexing, and ultimately you get to an EBITDA outlook where we've got EBITDA growth of about 10% this year and 9% next year. This year we get to 5% above 2019 levels. Next year we expect EBITDA to peak around 14% above 2019 levels. And then we've got modest declines in hotel EBITDA beginning in 2025 as top line growth really doesn't outpace expense growth, plain and simple. Before we move on to values, I want to talk about cap rates a little bit. So we get a ton of questions related to the impact of interest rates on cap rates. Now, intuitively, as interest rates rise, cap rates should rise, right? It kind of makes sense. However, over the last 20 years or so, that's not really how things have played out. And the reason for that is that historically, as interest rates rise, they've risen during a period of economic confidence. And the outlook for economic growth is stronger. And if the outlook for economic growth is stronger and you have more confidence in it, then you have less risk in that then you have less risk built into your underwriting. Less risk means a lower cost of equity, if you will. So there's been this dynamic that rising rates have been historically translated to lower risk from an equity perspective. So increasing cost of debt translates into decreasing cost of equity, right? Net cap rates don't change. If you look at the data here, what you see in the area portion of this chart is US hotel cap rate data from CoStar. And then the columns down at the bottom are the 10-year treasury yield. And what you can see, if you look at things on a quarter-to-quarter change, there is a negative 2.5% correlation between cap rate data and treasury yield data. And there is a 0.1% R squared. Even if you try to smooth the data and not look at it quarter to quarter, but take a rolling 4-quarter average, then that is the same, negative 2.9 and 0.1. At the end of the day, movements in the 10-year treasury yield have not translated into movements in hotel cap rates historically. Let's look at it another way. I talked about why that was the case a minute ago. If you just focus on the spread between cap rates and the treasury yield as a quasi cost of equity. I know it's not exactly the cost of equity, but for simplicity's sake, we'll make that argument, right? The spread between the 10-year treasury yield and the cap rate is the cost of equity. The change in 10-year treasury yield is almost exactly mirrored in the opposite direction by a change in the spread historically. There's a negative 97.6% correlation and a 95.3% R square. And if you don't believe me, if we just invert the spread and you look right here, they move almost identically in opposite directions, which is what this chart shows with the inverted spread. So at the end of the day, historically, over the past 20 plus years, spreads and cap rate, spreads and interest rates have moved the same level in opposite directions, meaning that cap rates don't get impacted by rising rates. However, we now may be in a time where we have rising rates and economic uncertainty, which is the first time we can say that we've had that over the past 20 years. So that relationship has broken down over the past few months and may continue to break down over the next few months, and that would cause a spike in cap rates, as you can imagine. Whether that happens or not, we'll see. I think over the next few months, this is all going to get sorted out as either base rates start to stabilize, 10-year treasury yields stop growing, which is what Moody's believes, and economic growth kind of stabilizes, less risk of recession, more confidence, things like that, and then spreads will start to compress again. Net, we think that's probably where things go over the next 6 to 9 months, but it's going to take a little bit of time for us to work through that. So just some interesting things to keep in mind as you think about our cap rate forecast, some of the analysis that we've done, and the data behind it. So if you look at our cap rate forecast, the dark blue line here is CoStar's cap rate across the US, going back to 2005. Light blue line is the model we've built. Got a lot of noise related to the pandemic there, but if you strip that out, you'll see basically a relatively stable cap rate moving forward. Again, macro factors driving that cap rate over here. So you put it all together and you get our overall forecast. Supply, 1.4% this year, like I mentioned, pretty close to where we were a quarter ago. Demand, 3.3%, also pretty close. Net occupancy slightly higher than where we were a quarter ago. ADR, we've moderated a little bit, but it remains pretty aggressive, and RevPAR, right around 6.5%, slightly lower than where we were, but still pretty positive on a year-over-year basis. That translates to hotel EBITDA that's up over 10%, and then values up 6% as cap rates rise year over year, impacting that hotel EBITDA growth, or not impacting values relative to that hotel EBITDA. Looking out 3 years and 5 years, you can see that we continue to have a relatively positive view. All the metrics are positive. There's no negatives there, which is encouraging. But as we highlighted before, occupancy really does stabilize. ADR growth over the next 5 years will moderate relative to where we are this year, but staying pretty positive. RevPAR north of a 3% compound annual growth rate. Hotel EBITDA north of a 3% compound annual growth rate, and hotel values almost 2% compound annual growth rate. When we go back to that, the hotel values and where that's going, we talked about kind of 2022 being just 1% shy of 2019 levels earlier. Well, we forecast U.S. values to exceed 2019 levels this year, and reach the prior peak and exceed it next year. However, 2024 will be our peak for hotel values. We estimate values are going to peak around 7% above 2018 levels in 2024, and then we'll see modest declines tied to those slight EBITDA declines that we highlighted earlier, whether it's down 1 or 2% in 2025, 2026, and 2027. Modest declines, but declines nonetheless. Let's move on to some of the market highlights. I know everybody's pretty excited about market forecasts. These are the 50 markets that we track on a quarterly basis and issue forecasts for every quarter. These latest forecasts came out March 1 last week. Well, the next ones will be June 1, then September 1, December 1. You get the idea. Now, while these are the 50 markets that we track on a quarterly basis, we also do a ton of work on other markets all the time on a commission basis for clients. If clients are underwriting assets in a specific market or sub-market that's not on this list, they'll reach out to us and ask us if we can run a forecast for them, and we do it. So we have those capabilities. If you're ever looking for anything like that, just let us know. It's something we can turn around. Let's take a look at our 2023 RevPAR outlook. When you take a look at the 2023 RevPAR outlook, this is an interesting slide, and I know it's complex and probably a lot to digest, and all three of these are going to be similar. But the top chart is 2023 versus 2022 RevPAR growth. The bottom chart is 2023 versus 2019 RevPAR growth. And I wanted to put the two side by side on the chart, or above and below on the chart, because I wanted you to see kind of the differences. 2023 versus 2022, some of our strongest markets: San Francisco, San Jose, Houston, Minneapolis, right? San Francisco, San Jose, and Minneapolis are three of the weakest performers to date during the recovery. Houston's going to be strong. Hasn't been a super strong performer, but hasn't been terrible. That has to do with the energy markets being really, really strong as they continue to recover. But so you look at markets like San Francisco, San Jose, Minneapolis that are really strong here, but relative to 2019, there they are, three of the bottom four, right? So they haven't fully recovered yet. So what your baseline is really matters. When you say, well, what market's going to have the strongest growth this year? Is it growth relative to 22 or growth relative to 2019? Because growth relative to 22 in general is going to be driven by the lack of growth during 2021 and 2022, right? So taking into account those perspectives. Meanwhile, we've got Miami down here as market that we think is going to be one of the lowest, along with Mobile and Tampa, San Diego, Puerto Rico, markets that have been Palm Beach that have been really, really strong due to all the leisure. Well, guess what? Most of those are over here: Palm Beach, Orlando, Puerto Rico, Mobile, Tampa. There's Miami, all among the top performers relative to 2019. So understanding that dynamic is really important. Now, not everybody that's been really bad relative to 2019 is going to be really strong in 2023 either. There's plenty of markets, especially East Coast. Boston's a market where we don't see a ton of growth this year. Same thing, you get markets like St. Louis and Louisville, Chicago, which are more middling of the pack as opposed to all the way over here. Just a few things to keep in mind. Now, let's fast forward a little bit. Let's take a look at a 5-year outlook from 2019 to 2027 from 2023. So now we're saying a 5-year forecast from 2022 moving forward on the top, and then 2027 relative to 2019 on the bottom. On the top here, again, you'll see some of those markets that have been the slowest to recover towards the top here. Las Vegas also makes it in here, but most of those are markets that have been the slowest to recover. And unfortunately, if you look at San Francisco, it's still down here. San Jose is a little further along, but still pretty far towards the right side of the chart. On the flip side, some of the markets that are going to see the lowest growth, like Miami, are actually much better over here. So just keep in mind longer term, shorter term. But ultimately, as we think about growth over the next 5 years, we love Las Vegas. We think there's a ton of growth across that market. It's our #1 economic growth market. Got great leisure, great group, growing corporate transient. DC will benefit from growing international demand over the next few years, but it faces a lot of other hurdles. And it's hard to get overly excited about that one. And a lot of the other markets that you'll see further up here are really just off of very low bases. And if you look at some of these markets down here, a lot of the leisure, Palm Beach, Orlando, Memphis, Tampa, Puerto Rico, Mobile, Anaheim, Miami, et cetera, they're very leisure oriented. Cleveland's probably the anomaly that fits into that camp, where Cleveland's actually pretty high on both of these lists. And that really comes from a lack of supply and a low ADR. Cleveland has negative supply growth with a few hotels having been removed from inventory. And on top of that, they have it's a market that has a relatively low ADR. So moving the needle $1 or $2 has a bigger impact. So just something that we worth highlighting. And then when you look at a 5-year outlook for hotel values for the 33 markets that we actually forecast all the way down to the bottom line and values, again, we're looking at 2027 versus 2022 at the top and versus 2019 at the bottom. Over the next 5 years, we see really strong growth in Los Angeles, Dallas, Minneapolis, Seattle, and Las Vegas. Those are going to be strong. Seattle and Minneapolis, a lot of that growth is really driven by the lack of recovery to date, and hopefully that continues. And then so you're seeing a little bit of a bounce back there, I should say. But whereas Los Angeles is actually we think it's going to be a strong market. Again, we really like West LA. We don't like downtown LA. There's just too much supply and not enough demand in downtown LA. But if you look further west, Hollywood, Beverly Hills, Santa Monica, we think those areas are particularly strong. Even Inglewood, Dallas, really strong economic growth. New convention center. All these things are really positive for the Dallas market over the next few years. And then Las Vegas, we talked about really strong top line growth. Expense growth is kept in check, and that leads to really attractive values. Looking out over the next 5 years, markets that we're most concerned about over the next 5 years, it's Boston, San Antonio, New York. We've got Salt Lake on there, but that's also partly because we think Salt Lake has recovered really strong. If you look at where Salt Lake is in the bottom here, it's actually pretty solid. It's nowhere near there. Miami, again, same type of story. Miami, we've got a slight pullback over the next 5 years, but it's still, I think, ranked #6 relative to 2019. So 5 or 7 relative to 2019. So still really strong when you think about it from a different point of view. Bottom line here is your baseline really matters? Are you focused on where values were in 2022 or where values were in 2019? Because you get a very different answer based on what you're looking for, what your question is. Now, up until now, we've really spent all this time focused on kind of the market the national macro, and then drilling down to the market macro. One of the super cool things that we're doing at Lark these days is going from the macro to the micro. And we launched a new tool called Lark GIS. And Katie just dropped a link to it in our in the chat, so you can check it out there if you're interested, where you can learn a little bit more about it, or reach out to us if you want to demo and learn more. But bottom line with Lark GIS is you can take all of this data that we're talking about at the market level and the national level and really drill it down to the property level. Get it down to what's around my hotel and what are the demand drivers around my hotel, and how does the economic data around my hotel stack up to the market overall, to my competitors, all those types of things. And not just my hotel, whether it's a hotel you own, a hotel you operate, a hotel you're developing, a hotel you lend to, all those things. Pretty cool. Oh, and I just heard that you guys can't see what's in the chat. So the link is www.larkanalytics.com/GIS. And you can check that out if you're interested. Sorry, the link didn't go through. So what makes Lark GIS unique? It's focused exclusively on the hotel industry. It enables the user to objectively assess the quality of any hotel location or development site in the US. Takes into account all the data that we've talked about throughout this presentation, but at the micro level for that specific property. And we aggregate all the data into something we call the Lark score. That quantifies the quality of any hotel's location. You can get data for economic activity and the outlook for 5 years, office employment, retail sales, meeting space, leisure demand, proximity. Actually, we estimate RevPAR down to the city block level as well. To give you a sense, if I scroll forward, here's Midtown Manhattan. You can see how granular the data gets. We've got every hotel in the country here, every hotel under construction, all the convention centers in the country. All data that we map is on an inventory adjusted basis. Data gets heat mapped down to the city block level. You can really pull all this data, and then you can take any property and build a trade area around that hotel, like within a 5-minute drive time of the Four Seasons Hotel Beverly Hills. We'll tell you what retail sales is and what it will be in 5 years and how that stacks up to the Los Angeles market and the nation. We can tell you what leisure demand is, or office employment, or economic activity, meeting space, RevPAR, all that data. And then we create a Lark score to actually tell you what the quality of that hotel location is on an index of 0 to 100. So a lot of information. It can be really helpful to anybody that cares about performance of a given hotel. And this is a pretty cool data. It's something that has been used across real estate classes for the last 20 years, but not for hotels, because GIS data has been historically very residential population oriented, but we've built a tool that is not residential population oriented, but oriented towards the factors that really lead to hotel demand and hotel sales and things like that. So I'll stop with that. Just feel free to reach out to us if you want to learn more. And then before I go to Q&A, a couple things I'll highlight. Number one is standard pricing for any of our reports that we walk through is right here. We do all kinds of bundles, whether you're looking for one report or 5 or 10 or our full platform. More somebody buys, the more they save, but here's our standard pricing. And then before we open up to Q&A, I'll remind everybody, we will send out the slides within the next 24 hours, and we will get this posted up on our website shortly as well. And if you're interested in trying to connect at the Hunter Hotel Investment Conference in a couple of weeks, please reach out. Information at larkanalytics.com. And with that, Katie, you want to load up the questions?
I'm ready to go. Okay, this first one's a little long, but the contrast between the high correlation of GDP and RevPAR at the macro level and the low/0 correlation of local GDP and local RevPAR speaks directly to the massive shift in drivers of travel. With technology improving productivity and communications, and with Americans not returning to the offices, elective travel is driving growth by leisure, remote work, remote centers, business meetings and group, much more so than traditional road warrior business transient. No one wants to travel to many of the major cities anymore. Dirty, dangerous, and business no longer needs to be conducted in traditional urban locations. Business and economic growth is now location independent. Tectonic shift in our industry and a huge opportunity. I guess that's not really a phrase as a question. Would love to get your reaction to my statement above with respect to the material change in post-COVID themes that will continue to drive certain forms of travel and will result in continued erosion of traditional forms of travel.
Okay, thank you, Katie. So look, I think that there is no doubt that there is a change, there's a shift going on, and we talked a lot about it with corporate versus leisure. But I think what's kind of interesting is if you look at a market like Palm Beach, the economic activity is heavily leisure oriented, right? And you actually see a positive, like let's take Palm Beach is the first column right here, right? And you see really strong RevPAR growth, but you see positive GDP growth. Compare that to a New Orleans, where RevPAR growth is positive, but GMP growth is negative, right? Or compare that to Seattle, where you have positive GMP growth, negative RevPAR growth. Or compare that to an Austin, where GDP growth is really strong and RevPAR growth is more muted. At the end of the day, there is no doubt about it that as we have seen corporate transient travel moderate from pre-pandemic levels and leisure be a big driver, that's having an impact on the relationship between economic activity at the local level and RevPAR growth at the local level. But at the end of the day, in leisure markets, you know, to give you an idea, if you look at a leisure market, Mobile, Alabama, why is Mobile, Alabama the #2 rated RevPAR growth over 2022 over 2019 when there's no economic growth, right? You know, this is a leisure market, right? It's all leisure oriented, but economic growth has nothing to do with it. You know, whereas Palm Beach is right here, Tampa's higher, just about all of these other markets are higher. So the breakdown isn't just about corporate versus leisure. It's also about the drivers of that leisure travel, where the feeder markets are, what comes, you know, where it comes from, whether you're international versus domestic, all these different factors that really play out. There's not one answer in saying corporate versus leisure. You really have to understand the drivers of our markets. When we look at an individual market, to give you some perspective, we look at leisure factors for certain for certain markets. Things like personal savings rate that we highlighted here are really important. For others, it's consumer confidence. For others, it's personal discretionary spend across the US. For others, it might be aggregate spending. For others, it's going to be retail sales, which is a very strong relationship with leisure demand. Every market has different factors that really prove to be relevant to that market. And if you can identify and understand what those factors are, you're going to be in a better position to be able to forecast how those markets are going to perform going forward than if you can't. And that's what we do.
Next
Thanks,
question.
Katie.
Yep. If we are seeing the average savings rate drop for the normal household, why are we bullish on ADR? Won't leisure travelers be looking for some value and incite a potential ADR decline?
Well, I think that there's risk in the near term, without a doubt. But I would put the flip side of that is if you've got group up 15%, you have fewer rooms to sell. And if you have fewer rooms to sell, you have some more pricing power. We don't think that, and don't get me wrong, we're not of the view that ADR is going to be up, 15% like we saw in 2022, but we think it's going to be able to be positive where, especially more urban properties and properties affiliated with large group houses are going to be able to be much more aggressive on rate. Do we think every market is going to be up up the 4.5% that we're forecasting for ADR? Absolutely not. Most of the markets that we've highlighted as being strongest in terms of ADR recovery to date, we think will actually be down in ADR this year. But those are more leisure-oriented markets. Leisure hasn't had that big of an impact in a lot of the core urban markets, where you're going to see benefit from improving corporate transient and improving group.
I think you said leisure was at 150% of 2019 levels in 2022 and will stabilize at 130 of 2019 levels. Is that, in parentheses, is that RevPAR contributions? What does that mean?
That's overall demand levels. So it doesn't take into account ADR.
What does that mean for leisure-driven markets which have been in favor? Miami Beach, Hawaii markets, Napa, Ski Town. Does that mean RevPAR will go down close to 15% off of 2022 levels?
Well, first of all, it was a demand metric, not a RevPAR metric. So the answer would be no. And second of all, if you go back to our outlook for RevPAR, what you'll see is a lot of those leisure markets over the next few years are the ones that we think are going to lag, over the next few years. Miami, Phoenix, over San Antonio, Salt Lake City, Mobile, Norfolk, which has Virginia Beach, San Diego. Those are the markets towards the lower end of our ranges, whereas the growth rates are going to be strongest in more corporate-oriented markets as they continue to recover. Doesn't mean that things are going to be down. It just means you're not going to see a lot of growth. Keep in mind, it's not like markets like Miami have no corporate demand and no group demand. That's not the case. They certainly do, but the leisure will wane. And those metrics are national, not specific to one market. So you'll end up seeing whether you can fight for some of that demand and win more of it.
And as of right now, this is the last question we have. Do you anticipate ESG initiatives to have an impact on expenses/valuations?
In short, no, I don't. In long, we will see. There's been a lot of research on ESG initiatives and whether they will ultimately have an impact on how businesses operate. We have not, up until now, it's been more talk than action until we start to see more details surrounding the action and the business decisions changing based on ESG initiatives. We don't see it having an impact.
And that's the last question.
All right, everybody. Well, thank you all for joining. I hope that you found the presentation helpful. And if you have questions, need anything else, you know how to get a hold of us, information at larkanalytics.com. And like I said, we'll send the slide deck out shortly. Have a great day.
Thanks, everyone.